Vital Farms hit another new low today. However, I've realized that at this price point, the company now possesses significant M&A, mergers and acquisitions value. The current valuation actually makes me less worried. While class action lawsuits force institutional investors to reduce their positions, further driving down the price, they do not impact the company's core operational competitiveness. The lawsuit risk: noise versus reality. Due to management repeatedly claiming everything is fine during the 2025 ERP failure, followed by a rapid implosion, the company is facing multiple securities fraud class action lawsuits as of April 2026. This is likely why the stock remains cheap and continues to bleed. The market is waiting for the settlement amount to be finalized. Estimated settlement. According to historical data, for example, NERA Economic Consulting, the median settlement for such securities, class actions, ranges between $10 million and $30 million. Given that VITL is a small to mid-cap company with a $550 million market cap, the likelihood of a sky-high payout, over $100 million, is extremely low. Insurance cushion. Companies typically carry high-limit D&O, directors and officers insurance, meaning a majority of the settlement and legal fees will be covered by the insurer. Hard data hedge. Even in an extreme scenario where the company pays $30 million out of pocket, that represents only 26% of its cash on hand, $113 million, or less than 4 months of EBITDA. Conclusion: legal risk is a liquidity shock, not an existential threat. It is financial noise that doesn't hurt the brand's competitiveness on grocery shelves. 1. Valuation. Mismatch. Buying the brand, getting the factories for free. Ultra-low entry point. The market cap is currently only $550 million, while 2026 projected revenue exceeds $900 million. Hard data, a 0.6 times. PS, price-to-sales ratio, is unheard of for a premium food brand. Comparable acquisitions in the high-end food sector usually happen at 2 to 4 times PS. This means the market has completely stripped away VITL's brand premium, pricing it as a mere raw material processor. Zero leverage assets. Balance sheet. As of the latest report, long-term debt is $0. In a high-interest rate environment, a company generating nearly $1 billion in revenue with zero interest expense is a rare gem. Cash flow protection. With approximately $113 million in cash, the enterprise value, EV, is only about $440 million. Paying $440 million for a company generating $100 million in annual EBITDA is what we call picking up a free wallet in the M&A world. 2. Industry giants, anxiety, and VITL's halo. Growth bottlenecks. Giants like Tyson or Campbell's Soup desperately need healthy/organic DNA. Quality of earnings. Despite the ERP issues, VITL's gross margins remain at 30% to 35%, far higher than traditional poultry companies, usually 10 to 15%. A buyer isn't just buying growth, they are buying margin expansion. Plug and play. VITL is already in 28,000 plus retail stores. An acquirer could integrate VITL into a more mature cost hedging system, potentially boosting net income per dozen eggs by over 15%. 3. The 2026 M&A landscape premiumization. Consumers are still willing to pay for transparency. Cash flow resilience. Even during the chaotic 2025, cash flow from operations, CFO, remained positive, approximately $85 million. This non-bleeding expansion proves the business model is rock solid. Barriers to entry. VITL has a network of 600-plus partner farms. This ecosystem took 10 years to build. For a competitor to replicate this from scratch, the time and cost would far exceed $500 million. 4. Who is the likely buyer? Danone or Nestlé? Seeking ESG premiums and high margins. General Mills. Experts at operating high-stickiness consumer brands. Private equity, PE. This is a hard arbitrage play. With a PE ratio of only 8 to 9 times, a PE firm could execute a leveraged buyout, LBO, using VITL's debt-free balance sheet, essentially buying this cash cow with very little of their own capital. Risk assessment: why it won't fail. Looking at the stock price makes me worry about bankruptcy, but these 3 metrics bring peace of mind. Zero default risk. No bank loans means no one can force a liquidation. Ample cash. They have enough cash to operate for over a year, even with zero revenue, and they are actually raking in cash daily. Endogenous growth. 2026 revenue growth is still projected at 20%. In business, as long as growth and margins persist, management hiccups are eventually swallowed by profits. Summary: at a $550 million valuation, VITL is a classic deep value M&A target. While management is visionary and unlikely to sell voluntarily, the M&A floor price ensures I don't have to worry about this egg shattering completely. Financial bottom line: the company has $100 million plus in cash, $100 million plus in annual EBITDA, and a new $150 million facility nearing completion. The replacement value of these 3 components alone is close to the current market cap.